Most borrowers think their mortgage rate is decided by one thing, their credit score. And that's simply not true. Credit score matters, but it's only one piece of the equation, and it's a much bigger equation than just your credit score. The reason this matters isn't because when people don't understand how mortgage rates are actually determined, they feel confused, frustrated, and sometimes cheated. They'll say things like, well, my credit's great. Why is my rate higher than expected? Or I hear this one a lot, my friend got a better rate than me, and our situations are basically the same. Here's the truth, they really aren't. A mortgage rate is not a reward for good behavior. It is a price for risk, and lenders price risk using multiple variables at the same time. Credit score is just one of those variables. It's the one people latch onto because it's the one they really understand the most. But lenders don't lend based on scores alone. They lend based on probability. Probability that you'll repay the loan as agreed over a long period of time through an economic cycle. That probability is shaped by several factors. The first is credit behavior. Not just your score, but how you use credit. Do you carry balances? Do you pay on time consistently? Do you open new accounts frequently? Do you have a long history or a short one? Two people can both have a 740 score and look very different to any lender. One may have low balances, long history, and stable patterns. The other may have high utilization and recent changes and thin depth. Same scores, different risk. The second factor is income stability. So not just credit, now we're looking at your income. Lenders care deeply about how predictable your income is. Not just how much you make, but how reliably you make it. Salaried W-2 income with a long track record is considered a low risk for a lender. Commission income, bonus income, or self-employed income can still be very strong, but less predictable. Less predictable income means more documentation and sometimes more conservative pricing. Again, this isn't personal, it's math. The third factor is debt obligations. Lenders look at how much of your income is already committed, car payments, student loans, yachts, planes, helicopters, other mortgages, all sorts of things, right? Even if you qualify within higher guidelines, higher obligations mean increased risk. Risk doesn't disqualify you. Sometimes it just changes the price. That's an important distinction. The fourth factor is liquidity. How much cash do you have after we close on this house? Not how much you're putting down, how much you have left. Borrowers with reserves are statistically more resilient. They're better able to handle surprises. That lowers risk. Lower risk often improves pricing. This is why two buyers with identical down payments can receive different rates. One drains every dollar to close, the others keep reserves. From a lender's perspective, those are very different profiles. Another major factor is loan structure. You've heard me say this before, fixed versus adjustable, long-term length, occupancy type, property type. A primary residence is less risky than an investment property. A single-family home is less risky than a condo. A shorter loan term may price differently than a longer one. These things change how the loan performs over time, and lenders price accordingly. Another piece most people miss is loan-to-value ratio. How much equity are you starting with? Higher equity generally means lower risk. Lower equity means the lender is more exposed. That doesn't mean low down payments are bad. It just means the pricing reflects the additional risk. This is also why mortgage insurance exists. It's not a punishment, it's a risk offset. It's actually a great thing. Another factor that surprises people is timing. Rates are not static throughout the day. They move with the bond market. Markets are open. Markets react. Markets adjust. Locking in a rate in the morning versus the afternoon can sometimes change pricing. Locking on one day versus another can change it more. This doesn't mean you need to obsess over timing. It means timing is a variable, not a guarantee. This is also why lenders don't all quote the same rates at the same time. Each lender has their own pricing engine, their own margins, their own appetite for certain loans, their own cost of capital. Some lenders are more aggressive on certain profiles and others are more conservative. That's why shopping blindly can be a little bit misleading. The lowest advertised rate is often tied to a very specific borrower profile. Perfect credit, high reserves, low debt, simple income, short lock. Most real borrowers don't fit that exact box. When reality doesn't match the assumption, prices change. Another important concept borrowers misunderstand is points. Points are not good or bad. They're just simply a trade-off. You're paying more upfront to reduce the risk for the lender over time. That's why points lower rates. Whether that makes sense depends on how long you plan to keep the loan. Without that context, points are meaningless. A low rate with heavy points can be a terrible deal if you move or refinance early. A slightly higher rate with no points may be smarter, but you can't know that without understanding your timeline. And this is where many borrowers tend to get misled. They compare rates without comparing structure. They hear lower and assume better, but better depends on context. Another thing that impacts pricing is lock strength. A longer lock costs more because it exposes the lender to market risk. Shorter locks are cheaper. That's why new construction loans are priced differently than resale transactions. Longer timelines mean more uncertainty. More uncertainty means higher pricing. Again, not personal, probability. One of the biggest mistakes borrowers make is assuming rate is a judgment of them, and it's just not. It's a reflection of risk variables interacting at a moment in time. That's why rate changes. That's why quotes expire. That's why two people don't always get the same outcome. This is also why obsessing over 1/8% often misses the point entirely. An eighth matters, but not as much as people think. What matters is, does the payment work? Is the structure flexible? Is the risk understood? Is there a plan? Is there an end game? Borrowers who understand this feel calm, and borrowers who don't understand this feel frustrated. They feel like the system is arbitrary. It's not arbitrary, it's just a little complicated, and complexity requires explanation. So here's another important truth. The best rate is not always available to the best borrower. Sometimes it's available to the borrower that fits the lender's appetite at that moment in time. This is why experience matters. An experienced advisor will know and ask the right questions what lenders favor which profiles. Which structures price best in certain markets, when to lock, when to wait. That knowledge doesn't show up on a rate sheet. It shows up in outcomes. And this is why two borrowers can do everything right and still get different rates. It doesn't mean one failed. It means the variables weren't identical. The mistake tends to happen when people assuming they were. Here's the bottom line. Your mortgage rate is the result of your credit behavior, your income stability, your liquidity, your debt profile, your loan structure, and your property type, as well as market conditions and timing. No single factor decides it, and no single improvement fixes everything. This is actually good news because it means borrowers have levers. You can improve credit behavior, you can plan for reserves, you can structure intelligently, and you can choose timelines strategically. You're not powerless, but you do need to understand how it works. The borrowers who feel confident aren't the ones with the perfect profiles. They're the ones that understand why their rate is what it is. Understanding removes fear. It removes frustration. And it allows you to make decisions based on reality instead of assumptions. That's the difference between guessing and advising. And that's why knowing how lenders actually decide rates matter. Not so you can game the system. I mean, I'm fine with it, but really so the game doesn't confuse you. The system doesn't confuse you. Have a good day.